Think back to your time in high school. You spent hundreds of hours learning about the mitochondria. You memorized dates of ancient battles. You learned how to calculate the area of a triangle using the Pythagorean theorem. But ask yourself this: how many hours did your school spend teaching you how to file your taxes? How many hours did they spend explaining what an index fund is, or how compound interest works, or how to negotiate a mortgage? The answer for 99% of people is zero. This is not an accident. The education system was not designed to make you wealthy. It was designed during the Industrial Revolution to create obedient factory workers. It was designed to teach you how to sit still, follow instructions, and wait for the bell to ring. The system trains you to be a good employee, but it never trains you to be a good owner. As a result, millions of people graduate with degrees, get high-paying jobs, and spend their entire lives broke, stressed, and drowning in debt. They are playing a game with the wrong rulebook. Welcome to Infinite Systems. Today, we are going to deliver the missing lesson. I am going to give you a crash course in financial literacy. We are going to cover the 5 core pillars of wealth that the rich teach their kids and that the middle class is never exposed to. By the end of this video, you will know more about money than your boss, your parents, and your teachers combined. Let's uninstall the employee mindset. Pillar number 1, the difference between an asset and a liability. This sounds simple, but it is the foundation of all wealth. The middle class defines an asset by its price tag. If they buy a $50,000 car, they think they acquired an asset. The rich define an asset by its cash flow. An asset is something that puts money into your pocket, whether you work or not. A dividend-paying stock, a rental property, a profitable business. A liability is something that takes money out of your pocket. A car payment, a boat, designer clothes. Here is the controversial truth that most people refuse to accept. Your primary residence, the house you live in, is a liability. It does not pay you. Every month, it takes money out of your pocket for the mortgage, the property taxes, the insurance, and the maintenance. Yes, it might go up in value over 30 years, but it is not a productive asset until you sell it. The rich buy assets first. Then they use the income from those assets to buy their liabilities. The poor buy liabilities first, and they use their labor to pay for them. If you want to be wealthy, your only job is to aggressively acquire things that pay you. Pillar number 2, savers are losers. We are taught from a young age that saving money is the responsible thing to do. Put your money in a piggy bank. Keep it safe in a checking account. In 1950, this was good advice. Today, it is financial suicide. We live in a fiat currency system. The government prints trillions of dollars every single year out of thin air. This causes inflation. Inflation is a hidden tax on your savings. If inflation is running at 5% and your bank pays you 1% interest, you are losing 4% of your purchasing power every year. Your money is a melting ice cube. The wealthy do not save cash. They understand that cash is a medium of exchange, not a store of value. They use cash to buy hard assets, real estate, businesses, gold, Bitcoin, and index funds. These assets rise in price as the government prints more money. If you want to survive, you must stop hoarding paper dollars and start hoarding productive assets. Pillar number 3, good debt versus bad debt. School teaches you that all debt is evil. Stay out of debt, pay off your credit cards, pay off your house. This is only half true.
Bad debt is evil. Bad debt is borrowing money to buy things that go down in value. Financing a vacation, putting a TV on a credit card, leasing a luxury car. This debt makes you poorer every single month. But good debt? Good debt is the secret weapon of the ultra-rich. Good debt is borrowing money to buy an asset that puts money in your pocket. Imagine you borrow $100,000 from the bank at a 5% interest rate to buy a rental property. The property generates enough rent to pay the bank's 5%, cover the taxes, and still put $500 a month in your pocket as profit. You just created cash flow using other people's money, OPM. You didn't use your own money, but you get to keep the profit, and you get to keep the appreciation of the house. The rich use debt as a tool to multiply their wealth. The poor use debt as a tool to consume. Mastering leverage is the key to escaping the middle class. Pillar number 4. Taxes are for employees. This is the most unfair pillar, but you have to understand the rules of the game. The tax code is written by business owners and investors for business owners and investors. If you are a W-2 employee, you are taxed on your gross income. The government takes their 30% or 40% before the money ever hits your bank account. You have zero control. But if you are a business owner or an investor, the rules are completely different. A business owner earns money, spends that money on business expenses, and then pays taxes on whatever is left over. Investors pay a lower capital gains tax rate than employees pay on their labor. And the ultra-rich, they use a strategy called buy, borrow, die to legally pay 0% in taxes. They buy assets that grow in value. They never sell those assets because selling triggers a tax event. Instead, they go to a bank and borrow money against their assets. Loans are not taxed. They live on the borrowed money, tax-free. When they die, their assets pass to their children with a stepped-up basis, wiping out the tax bill entirely. You don't need to be a billionaire to use the tax code. You just need to stop thinking like an employee. Open a business, invest in real estate, use legal tax deductions. Don't just work hard, work smart. Pillar number 5. Pay yourself first. When the average person gets their paycheck, what do? They pay the landlord, they pay the car company, they pay the government, they pay the grocery store, and then if there is anything left over at the end of the month, they save it. Usually, there is nothing left. This is a recipe for lifelong poverty. The wealthy do the exact opposite. They pay themselves first. Before the landlord gets paid, before the car company gets paid, the first 20% of their income is automatically transferred into an investment account. It happens on the first of the month, like clockwork. You don't even see the money. You don't have the option to spend it. You force yourself to live on the remaining 80%. By paying yourself first, you guarantee that your wealth grows every single month, regardless of your discipline or your willpower. You automate your way to millions. So here is your graduation from Infinite Systems. You now know the 5 pillars. Buy assets, not liabilities. Stop saving cash, start buying assets. Use good debt to multiply your wealth. Understand the tax code. Pay yourself first. The school system failed you. It taught you to memorize, but it didn't teach you to thrive. But you are no longer a victim of ignorance. You have the map. Now you just have to walk the path. Stop complaining about the rules, learn them, and use them to your advantage. Welcome to the system.